wasting money on cures. Forgot how to fix myself. They say that time is free. Then why is it so precious? Oh, I'll say memories in my head, like Polaroids on walls. They remind you to look ahead. Time is running out. Time is running out. Lately I've lost my track. I've sailed the deepest seas, hoping to find something to bring back better times. Oh, I'll say memories in my head, like Polaroids on walls. They remind you to look ahead. But time is running out. 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 Time is running. Time is running out. But time is running out. What if my best days aren't over? They can be over. They can't be over now. Time is running out. What if my best days aren't over? They can't be over now. Time is running out. Time is running out. Time is running out.
Okay, good morning. Welcome, everybody. Welcome to another week of revision as we head full steam towards the exam season. We can do a huge amount together collectively if we chip away at key topics. And that's out of this session. We're going to be looking, we're going to have a hot take on exchange rates today. I've got lots of questions for you, some interesting examples and little case studies. And then on Wednesday, we're going to do balance of payments. And then Thursday, I think we're doing Monopoly. And Friday, all the different types of elasticities, how you can apply them in different parts of the A-level course, both micro and macro, in fact. So 4 sessions this week. As always, if you're watching live, welcome. Press like and subscribe. Subscribe so you can contribute to the live chat. We have an amazing group of students who have been, I think this is now session 13 or 14. Some of them have been to every single session. It wouldn't be the same without you. So if you're subscribed, you can contribute when it comes to the questions. And thank you to those in the group who are helping others who have questions we don't quite have time for. If you're watching on catch up, just press that pause button anytime you want to take a moment to take a screenshot or think about a question, or take your time. Okay, so welcome to those who are either writing essays or have escaped in a free lesson, or maybe school not quite back yet. Here we go. Here's our big reveal. Now, we're not going to put the right answer up until the end, but we're looking for the right country. I've got a country. First of all, the IMF classifies this nation as an emerging and developing economy. That's the first clue. So which student here today can get the right country first time up? Try and limit yourself to maybe 2 goes at this. Don't just whack 150 countries in. Alex says Ghana. Ben says China. Not quite right. The economy has been suffering from very high rates of inflation. So what do we think here? Juicy J thinks Nigeria, Ria, and Gillies think India. Toby thinks Somalia. Toby, the answer to every question is always Somali, by the way, or Finland. Javian thinks Argentina, and Siani thinks Mexico. The next clue, the currency has been weak, as you'd expect with high inflation, despite a rise in interest rates to 50%. To 50%. What do we think there now? Zimbabwe's coming in, Costa Rica, Argentina. It'll be a cracking FIFA qualifying group. Home and away to Costa Rica. Clue 4. This country is inside the European Union Customs Union. It's inside the Customs Union. Now, we do have several correct answers, and we have spotted the first one, I think. And Rita says Turkey, I think. Vu Hailam might well have got the first correct answer. Vu Hailam, congratulations. Alex says Turkey. Barack Obama. Amazing that former US presidents are willing and able to join us on our live streams. Jack says, sorry, I'm late, Geoff. I've just run from the gym. Well done, Jack. Left foot, right foot, left foot, right foot. That's today's running order, Jack. And the currency is the lira. Now, Turkey is a good example, but the answer is Turkey. Well done, everybody. Ollie says Turkey. So Turkey is a good example of a country that is actually inside the EU Customs Union. The Snap Bandit, one of our great contributors, says, think I was first. Go look up the chat. Well, we will do. We'll send half of our team now into the chat to see if that is right. But the good news is it is Turkey, and also that Jack has joined us from a session in the gym. That just shows the commitment that students have. Okay, here we go. Let's look at 5 multiple choice questions, all to do with exchange rates. So here's the first question. Which term relates to a fall in the domestic... Which term relates to a fall in the domestic real value of a currency? So is it deflation, depreciation, appreciation, or inflation? Which term relates to a fall in the domestic real value of a currency? Lots of people here saying B. In fact, everybody saying B. And it's the wrong answer. So this is why I chose this question. So it's not B, but the Snap Bandit is correct. James Yates, well done, James, and one or two others coming through. The answer is indeed D. The clue there was domestic value of a currency, whereas exchange rates, of course, is the external value of a currency. Inflation reduces the real value of money domestically. Deflation increases the real value. So Ben got D, and Sigma says E. No, it's not E. Number 2. Reducing the exchange rate helps decrease the country's current account deficit because it makes imports more expensive and exports cheaper. What does this statement describe? Pardon me. So lowering the exchange rate can help to decrease the current account gap because of it makes imports more expensive, exports cheaper. Lucy says, sorry, I'm late, Geoff. I was watching your fiscal policy video. Well, that's a perfectly legitimate excuse, Lucy, but thank you. Welcome back. Most people here going D. Let's just double check. It is indeed D. A fall in the exchange rate is an expenditure switching policy. Well done on that. Good phrase to use, by the way. Question 3. Now, this is slightly harder. The diagram shows ADS curves. Indeed, it does. The initial point is at E. Now, we're told the sum of the elasticity of demand for imports and exports is greater than 1. Kind of important. The devaluation of the country's exchange rate will cause aggregate demand to change. What will be the new equilibrium? And the Snack Bandit comes in straight away with a quick reference there to the Marshall-Lerner condition. Super important. Zach says, sorry, I was late. So what have we got? Zach, Lucy, 1 or 2 people coming from the gym, people finishing their essays. Toby's writing an economics essay at the moment on perfect competition. What do we got here? What do we think the answer is? Ben's right. Difference of opinion here. And the right answer is indeed B, because the Marshall-Lerner condition holds, therefore a devaluation will improve net trade. X minus M will improve. And of course, X minus M is part of C plus I plus G plus X minus M. Okay, good stuff. Question number 4. We're going at a good pace today. Country has a balance of trade deficit. When will this be least likely to be improved because of a depreciation of the currency? These are all 2022, 2023 multiple choice questions. What do we think here? Questions coming out. Most people here going for B. Let's just double check. It is indeed B. Of course, it's the reverse of the Marshall Law notes. In other words, the trade deficit may get worse initially following a depreciation of the currency. And finally, question 5. I like question 5, by the way. Here we go. Let's read it through together. A small island economy imports most of its raw materials, and demand for its exports is price elastic. Okay. What would be the most likely effect of an appreciation of the currency on the balance of payments on the current account and the rate of inflation? People arriving late, all kinds of reasons. People writing essays, people have been to the gym. We've got Turkish Dingle saying there's been engrossed in the juicy monetary policy 25 mark. I hope you used the phrase QE. Here we go. So can we keep everything civil, please? That'd be really helpful. So what do we think on this one? Question 5. Some differences of opinions here. So the demand for exports is price elastic. Appreciation of the currency. What's going to happen to the balance of payments and the rate of inflation? Right answer is coming up on the screen. The answer is C. Balance of payments will worsen because an exchange rate depreciation will worsen the balance of payments on the current account. You'll see a big fall in sales of exports, and fall in exports will bring down the rate of inflation, as well as it makes imports cheaper, of course, because they import most of the raw materials. So inflation will definitely fall because the things they import become cheaper. So well done to TJM and Faye and Victoria, who all got the right answer there, and Toby, which was C. Okay, let's crack on now. We're looking today at exchange rates. Just a bit of background, a bit of context. Pigeon says, how can I get faster at multiple choice? Practice. Just keep practicing multiple choice questions. Each question, Pigeon, tests one idea, essentially. So I want to give you a background to the currency markets, just to give you a sense of scale. This is the daily turnover of all currencies, every traded currency. And it's only up to 2022, but just keep in mind that the daily turnover of currencies, buying and selling of dollars, pounds, yen, euros, etc., is over $7.5 trillion. Now that is the equivalent of, let's say, the French and the German economy's GDP in 1 year. So 1 day's trading of currencies is the same as the combined GDP of, let's say, France and Germany in a year. We're talking billions, trillions of dollars of currencies traded every day. The US dollar, obviously, the world's reserve currency, 6.6 trillion. The euro is the second biggest traded currency. The Japanese yen, the third. Sterling, widely traded, about a trillion pounds worth of currencies traded. The yuan is about half that. So those are the big 5 currencies globally. Bit of context there. So that's really quite important. The global foreign exchange market is absolutely huge. Most of it's speculative, by the way. So moving on. Here's a chance to impress the group. Can you please give me one cause of a currency depreciation? Let's have a go. As always, we'll post some of the answers on the screen. What might cause a currency depreciation? Keep in mind, of course, this will be a floating exchange rate. Yeah, the sheer volume of trade in currencies is absolutely enormous. A lot of it's linked to trade, a lot of it's linked to FDI, obviously, but a lot of it is purely speculative, hot money flows, and other financial investments across borders. So Daniel has a nice, neat point there, low interest rates, a reduction in hot money flows. Nice point, well done, Daniel. Ben, again, links it to low or lower interest rates, leading to a net outflow of hot money. Good. And TGM has a nice link there with the value of the trade balance, the net. That's a really good point. So an increase in imports and a rise in the trade deficit. Louis talks about the hand grenade that is or was Liz Truss. G9 talks about the instability in the economy leading to capital flight. Great point. So if you're thinking about a currency depreciation, for example, in an emerging developing country where there is political uncertainty, capital flight leads to an outflow of currency. Really good. Kieran Woolley, one of our great contributors, talks about fall in FDI. And Lucas Brew talked about low animal spirits. This will cause a fall in foreign direct investment. All good stuff. Yeah, you've got it. This is the key. Can you think of causes? Here's my answer coming up on the screen. So one cause is a rise in imports. I think I shared an answer there with somebody, leading to a worsening net trade balance. So there's a net outflow of money. And crucially, I've put in the words ceteris paribus, partly because that's what I was taught at Cambridge. Always include the phrase ceteris paribus, or ket par, as we used to say at Cambridge. Happy days. So ceteris paribus, a fall in outflow of money leads to a currency depreciation. Jack says, Geoff, can you explain hot money? I certainly can, Jack. Hot money is basically where money flows around the world financial system, looking for the best risk-related or risk-adjusted rate of return. So in other words, money might flow into countries where there's relatively high interest rates, or where the stock market's doing well, or where there's property speculation, or whether the expectations of the currency will appreciate. So current hot money is basically money that moves very quickly around the world economy in search of the best risk-adjusted rate of return. And thank you to Ben for lauding my subtle Cambridge flex. Next outline question for you. Can you give me one way in which a central bank can influence a managed floating exchange rate? Have a go. So in today's session, we're going to be taking Bangladesh as our case study. Really interesting example of what's happened to exchange rates. Now, Bangladesh has moved to a managed floating exchange rate. Johnny asks, why does inflation lead to depreciation? Well, typically, Johnny, the currency traders they don't like countries with high inflation. The real return on investments goes down, and therefore that's why people tend to sell the currencies of countries with high inflation, if that makes sense. Emily there talks about the central bank changing interest rates, again influencing hot money. Good. Archie talks about increases and decreases in the money supply. That could be a good way of doing it. Now, Juan Il talks about buying up domestic currency with foreign reserves. That's a really good point. That's a really good point. Adam says, can you explain what hot money is? I think I've just explained it, Adam. It's basically money that moves around the world economy looking for the best return. Lovely answer from Maria there. Through monetary policy, i.e. lower interest rates, Japan was negative. Really good application there, Maria. Buying and selling currency on the foreign exchange markets. Yeah, a really good example there from Maria. The Bank of Japan, one of the most interventionist central banks on the planet, deliberately trying to manage the yen, bring it down to avoid deflation. And they went to negative interest rates, and they also were significant buyers of foreign currencies and selling Japanese yen. Okay. Jimters10 says, watching along with the class, Geoff, we are loving it, baby. So if you give me an idea of which school that is, Jimters, and we will give a little shout out if you're also watching in the live class. Here's my answer, by the way, coming through. So one method is through direct intervention. So if the central bank wants to get the exchange rate to appreciate, it will sell some of its foreign currency, dollars, yuan, yen, etc., and it'll buy their own currency, reducing the supply of that currency in the market. Of course, the alternative, as somebody said, is to use a change in policy interest rates. So the central bank might raise interest rates. Now, very interestingly, Adam says, I'm watching from my colleague's library, but can you turn the sound down, Adam? Keep it quiet, please. Yeah, so a lot of countries have moved towards managed currencies. That assumes that the central bank has the wherewithal, has the foreign exchange reserves, has the clout to be able to move the price. My instinct is to say, as part of the evaluation, is that most central banks are price takers in foreign exchange markets. Obviously, the Bank of Japan, European Central Bank, the US Fed, and what have you, the People's Bank of China, they can move markets. But most central banks don't have the simple reserves to be able to move markets. Okay, here we go. So, Adam says he's got headphones. Great news, Geoff. Now, this is really important. So as part of your A-level, you will need to have some revision notes on the relative costs and benefits of different types of exchange rate system. So let's look at this question. Can you please give me 2 advantages of operating with a floating rather than a fixed exchange rate? Do have a go. Let's see what you can come up with. So countries have to make the decision about what kind of exchange rate system to operate with. It's one of the most important decisions they have. So why might, and we're looking for some really good answers. Daniel's come in with a great point. Freedom of monetary policy can be used for other objectives. Daniel, to make that even better, you say such as, give me 2 other objectives. Ron Hill talks about auto correction of the current account. Good stuff. Will Hodge has a nice point about the no need for large currency reserves. Helps respond to shocks. Great answer, Will. I'll talk about that in a second, actually. Quite a few talking about freedom of monetary policy. Emily, yeah, okay. So if the market sets an optimal exchange rate, maybe the country becomes more attractive to FDI. Felix talking about safety valves. Oh, this is really good stuff, everybody. Some great answers coming through. Absolutely fantastic answers. Well done. So Faye talks about floating, South Korea versus fixed, North Korea, Cuba, allows for more autonomous decisions. It does indeed. It gives you more autonomy. And keep an eye on the chat window, everybody, because the answers are lagging a little bit today. The Snap Bandit, one of our great contributors, talks about the opportunity cost of holding high levels of FX reserves. Absolutely. And that assumes, of course, that even high levels of reserves will be enough to manage a floating exchange rate. Yeah, really good stuff. Here's my two answers. Can I add value? Monetary policy or autonomy or freedom. So if you have a floating exchange, a free floating exchange rate, that gives you the freedom to set interest rates and QE to address growth, inflation, unemployment. So in other words, you don't have an exchange rate target, and therefore you can set your monetary policy with regard to growing the economy, controlling inflation, creating jobs without necessarily having to meet an exchange rate target. And of course, if you want to be bang up to date, it's not just interest rates, it's QE. So the pound is a free floating exchange rate. The Bank of England can set interest rates at the level it thinks is relevant. And point two is super important for the A-star students. Free floating exchange rate, in theory, gives countries more of a shock absorber. Very useful. So, for example, if you get a recession, a global financial crisis, the pound fell 15% in 2008, 2009. That gave a little bit of a boost to exports in the midst of a crisis. It made the recession less severe. Post-Brexit, after the referendum in 2016, again, the pound fell 10-15%. It gave the economy a little bit of a kickstart. So a fall in the exchange rate can act as a shock absorber to help rebalance the economy. As a rule of thumb, basically, as a rule of thumb, a 5% fall in the exchange rate has about the same effect on AD as a 1% cut in interest rates. So a 15% fall in the exchange rate is about the same as a 3% cut in interest rates, which is pretty significant. Okay, and you can use ADS analysis. Now the Snap Bandit comes and says counter-cyclical to the business cycle. So it essentially acts in a similar way to fiscal automatic stabilizers. That is an unbelievably great point. So a floating exchange rate can almost act as a kind of automatic stabilizer through using monetary policy. Superb point. And I don't know what the econometric data is, but there's some evidence that floating exchange rates do mean that your economic cycle is less volatile. And that's an amazing point to make. Well, if that's the case, let's think about the drawbacks. So essentially, this is our advantages of fixed exchange rates. But can you evaluate here? Can you give me two drawbacks of operating with a floating exchange rate? Have a go. So thank you for these. These are really interesting points. I love that in the chat that people are adding in points, which is just so useful. And hopefully those people watching on catch up, you're getting a good feel for how we're using exchange rates here. Adam says exactly 1 month until the first paper. Toby says, well, exchange rate says always asks you to compare the types of exchange rate. Yes, it's either the effects of exchange rates or relative costs and benefits of exchange rate systems or influences on exchange rates. It's a big topic, by the way. So why would you go with a floating rather than a fixed exchange rate? What are the drawbacks? It might discourage FDI. Investors are worried about exchange rates. Yeah, Big Man Francis talks about allows for speculation. So are they more vulnerable to speculation? Because here talking about fluctuations can cause uncertainty and deter investment. Lucas has a lovely point there. And what I love about the answer from Lucas is he brings in the point of animal spirits may haunt investments. Haunt. Yeah, so a lot of people here talking about uncertainty, unpredictability with a floating exchange rate. Don't assume, by the way, the floating exchange rate is more volatile. Often they can be quite stable. The pound's actually been quite stable against the dollar for the last 2 or 3 years, about 125. Felix has a nice point about less convenient for exporters as they need to be constantly changing contracts to match the exchange rate, which is a really good point. If you have a fixed exchange rate, you can lock in. It's probably easier to negotiate contracts. You kind of know what's going to happen to the price of your key imports, for example. What have I got in terms of points here? Because I want to get onto Bangladesh with you. So I've got the points about exchange rate volatility. So that's probably the case that floating currencies are probably more volatile. They don't have to be. It's not axiomatic. But the key point is it increases currency risk. And one consequence of that is that overseas buyers of government bonds might require a risk premium. So it might mean the government has to spend money more interest. Okay. Faye makes a really good point about fixed exchange rates, probably good for trade and investment because of that kind of point about floating exchange rates are a barrier to trade. Wow. Wowza. And point 2 on the screen for me is the idea that you're taking away the exchange rate as a policy tool. If you have a free float, you're basically losing the ability to manage the exchange rate. So some countries have moved to manage floating. Some countries have moved to semi-fixed exchange rates, and they can then intervene. Okay, so you can try and manipulate the exchange rate to have an impact on other job objectives, trade, growth, etc. Okay, so just very quickly, conscious of time here, everybody, we'll look at a couple more things, including how you can use ADAS diagrams to get grey marks. You just need to know the main exchange rate systems, fixed exchange rates, either with a currency board or with a conventional fix. So countries like Hong Kong fixed to the dollar, Bulgaria at the moment fixed to the euro, but Bulgaria looking to join the euro in 2025 or 26. Saudi Arabia fixed to the dollar, Senegal and Denmark fixed to the euro. Lots of Jamaica, Croatia, China, Ethiopia have a semi-fixed exchange rate system. Most countries have a managed floating system, including countries like Brazil, Turkey, South Korea, Mexico, interesting. But the UK, USA, Eurozone, Canada and Australia have a free floating exchange rate. Okay, let's look at one country in particular, just a couple of things to finish off with. Now, often in an exam, you'll be using ADS analysis. So it'll be examine the consequences of an exchange rate depreciation or assess the consequences. The strongest answers understand that currencies can affect both AD and aggregate supply. And also the impact of a currency movement depends on the stage of the cycle when it occurs. So keep that thought in mind. Let's look at a country in particular. Let's look at Bangladesh. Now, here's the exchange rate for Bangladesh up to and including the spring of last year. So I'm trying to choose a country where things were happening in 2022, 23, because the exam's been set in 2024. So back in the summer of 2022, Bangladesh central bank decided not to fix the exchange rate. You can see it was fixed, allowing the market to set the exchange rate. So Bangladesh essentially moving from a fixed to a floating exchange rate, and then the taka depreciated against the US dollar. It's fallen from 85 taka to $1 to 107, so a 26% fall in the exchange rate. So what I've tried to choose here is a good example of a country where something has happened to the exchange rate. They've changed the system, and their exchange rate has depreciated 26%. Let's just do a little bit of synoptic revision here. So my first question is, before we do that, sorry, you need to know that Bangladesh is heavily textile dependent for exports. The vast majority of their goods and export are green textiles, from t-shirts to woolly hats. On the other side, on the import side, Bangladesh manufactures textiles, but it imports, the next slide shows it imports cotton. So it's an import of cotton and oil and wheat and pharmaceuticals, etc. Okay, so over to you. I've got 3 very short, quick questions. Can you give me 2 micro effects of a currency depreciation in Bangladesh? So this is synoptic revision. Have a go. We did a quick video on Bangladesh last week, which has gone down very well in the subcontinent. Now we're just going to practice a bit of micro revision. Bangladesh currency has fallen 26%. So those of you taking Edexcel in particular paper 3, 5th of June, think about some of the micro consequences of a big fall in the currency. Gibbo, thank you for your very generous comments. Thank you. Emily talks about increased cost of imports. Oh, well, that's a great synoptic point, Emily. Increased variable costs. So if you're a textile manufacturer, your cotton becomes more expensive, decreasing their super normal profits. Excellent point. Ben's talking about increased demand for labor, but presumably through an increase in export sales. Yeah, you're getting this. So this is really good stuff. Anything to do with firms, individuals, households, industries is microeconomics. Alice talks about exports of textiles will be demanded more as it's relatively cheaper. Ben talking about the demand for labor going up, the derived demand for labor. Excellent stuff. What have I got in terms of points? Conscious of time, everybody. Fall in real incomes for households. So, of course, Bangladesh imports wheat, it imports fuel, it imports foodstuffs. So depreciation causes higher prices for food and energy, which can have a regressive effect on the poorest households and obviously a direct impact on their savings and their development. So you could look at the individual effects, that's micro, or as many people did, so textile exporters would see a rise in sales, hopefully. Travel and tourism would benefit. A weaker Bangladeshi currency might encourage travel and tourism. So an outward shift in AR and MR could lead to a rise in super normal profits. So anything to do with businesses or industries or individuals is micro. Moving on, can you give me 2 macro benefits for Bangladesh of a currency depreciation? Have a go. So now we go from micro to macro. And those of you who are EdXL students, this is all you have to do in the paper 3. You know, get some micro points, 1 micro point, 1 macro point. It's all you have to do. But they're testing your synopticity here. Okay. Archer talks about a fall in the current account deficit, which is good. Juan talks about some inflationary consequences there. Well done on that one. Yeah, Ben, that's right. So you could talk about the overall effect for Bangladesh unemployment, for example, or the employment rate or economic activity at a macro level. And I like the way that you brought in a multiplier effect. That's really good. The Shrimp talks about improving trade deficit. Pigeon talks about maybe attracting FDI into the economy, all good stuff. I like the way here everybody's getting the micro macro distinction. Here are my 2 points coming up. We've just got one more evaluation. So I've gone for increase in net trade. I use the phrase net trade. I suppose don't just say an increase in exports, but depreciation causes that expenditure switching effect we mentioned. So you should, in theory, get a rise in export volumes and the net trade balance improves. And multiplier employment effects, and also a positive accelerator effect. So the export industries may invest more in new capital. And often if you have a weaker currency, is a multiplier effect, it's macro point, Alex, definitely a macro point. Often in these countries, a competitive currency is a way of attracting FDI. So people base their manufacturing in your country, taking advantage of a competitive exchange rate and low labor costs, and then export to the regional trade blocks. And that's but you've got to keep a competitive currency and you've got to keep inflation relatively low. Last question. The macro costs for Bangladesh. So 22%, 25% depreciation. Why might that be a bad consequence for Bangladesh? Have a go. Some really good answers today on exchange rates. You've obviously right on it. I just want to walk you through, if it's okay with you, in the last 2 minutes, how to get great diagram marks for an exchange rate question. Toby says, are hot money flows always negative? No, they can be inflows, net inflows. A lot of countries, for example, that they raise interest rates, suddenly money starts flowing into their banking system. Dorothy has a lovely point there about imported inflation. Well done. Yeah, many of you getting the inflation point, which is excellent. And Ria making the point from that trade profile that Bangladesh is a net importer of cotton. Great answers coming through as always. Just takes a little bit of time for them to come through on the live stream. So well done to everybody. Casponian talking about cost push inflation. Some really good points. People do demand pull inflation potentially. Depends on the where you are in the cycle. Excellent. And Faye talking about the increased inequality as low-income households are unable to purchase necessities such as wheat and food. Increased likelihood of absolute poverty. Really, really good points. Excellent. What are my 2 points? I've gone for higher inflation. Yes. So typically, of course, a weaker currency. Here's a lovely phrase for revision, everybody. Many exports require imports. Textiles require cotton. Cars require imported steel. Okay, so Bangladesh imports petroleum, cotton yarn, wheat, pharmaceuticals. So these import prices going up can erode the competitive benefit of a weaker target. Of course, the risks are you then get a rise in inflation expectations. And my other point is, I think we've covered this with development, haven't we? A weaker currency increases the real cost of servicing debt. So if you've issued money, if you've borrowed in euro, the Eurobond market, if you've issued a debt in dollars, if you borrow money from the Chinese in yuan, that debt becomes much harder to repay, and many countries have suffered from currency weakness and increased external debt servicing costs. And a weak currency, of course, can lead to capital flight. So there are some big downsides to that. Fantastic, everybody. Just very quickly, can I just quickly walk you through how you can use an ADS analysis question? So let's think about Bangladesh and the currency depreciation. So the next slide just basically takes it the next stage further. So here let's assume we start off at Y1 with a general price level GPL1. Well, the next slide shows a fall in the exchange rate, which causes an improvement in net trade if the Marshall-Lerner condition is satisfied. So I know when I put AD2 brackets, improved net trade, just tells the examiner that you're linking the rise in AD to the trade balance improving. Now, to take it further, keep in mind what I've said in many sessions. We say this at Grade Booster, by the way, it's one of our hot takes from Grade Booster, that you need to shift at least one curve. Let's shift another curve. Let's put in an extra AD curve with a multiplier effect. So depreciation might cause an improved trade balance to AD2 and then a multiplier effect to AD3. And that might cause demand pull inflation, which I think quite a few of you mentioned in the answer. Now, then what you could then say is, of course, imports become more expensive. The cotton yarn, the pharmaceuticals, the fertilizer, the oil and gas, and therefore the next slide shows the aggregate supply curve shifting inwards. Now, this would, if you get a question on the exchange rate, everybody, this would be an A-star diagram, because you've said there are demand and supply side effects, which in theory might moderate the growth effect, but certainly amplify the inflation effect. Does this diagram make sense, everybody? We've shifted two AD curves, talked about trade balance improving, we've put in a multiplier effect, we've also shifted the aggregate supply curve to the left. If you wanted to take it even further, you might think about consequences for long and aggregate supply, but I won't do that in this diagram. There we go. That would be a really, really outstanding diagram if you wanted to draw that to evaluate and analyze the consequences of Will says a bit much going on in this diagram, Geoff. Well, Will, you may or may not be true, but that's what I want you to draw in the exam, because I know that gets an A star, because that's a high level diagram. Okay, I think you can all draw it in one diagram. A few diagrams that leave half a side of A4, be absolutely fine. Okay, everybody, well done. Absolutely brilliant today. 35 minutes on exchange rates. Hope you found that useful. If you did, press the old like button and subscribe to the channel, as over 1 million people now do. Absolutely outstanding answers. Huge thanks to everybody once again. We have this wonderful group that just turns up for each other most days, and we're taking a day off tomorrow, but we're back on Wednesday for a special revision session on the balance of payments. So as always, thank you for joining in today. Stay safe, stay happy, stay positive, stay curious, and see you sometime soon.